So guys, we spent Tuesday talking about the disposition of business assets, okay? We went over Code Section 1231, we covered the recap rules and some of the non-recapture rules. And those guys really, we focused on when a business takes some of its assets and sells them, okay? Today we're gonna look at some dispositions other than sales, and we're actually gonna look at one that is a sale, but it's sort of a, it's an installment sale, so the rules changed a bit. Now guys, anytime you dispose of an asset, okay, you sell or dispose of an asset, we call up Section 1001. Code Section 1001 is the one I wrote on the board last time that says you take the amount realized, what you receive in the disposition, minus the adjusted basis of the asset you're disposing or giving up in the exchange, and that is your calculated gain or loss, okay? And that is your realized gain or loss. Typically, where you have realization, again, you have recognition, and recognition simply means that you put the calculated gain or loss on the tax return. And for all the sales that we looked at the other day, of course, we are going to recognize those, so we're going to put those on our tax return. Today, we're going to spend some time looking at some dispositions that aren't going to go on our tax return because these are deferral provisions under the code, okay? Congress, for various reasons, has said that even though there is this triggering event, okay, you dispose of an asset, you don't have to report it at this time. The first type of exchange that we're looking at are what's called like-kind exchanges. These are also known as 1031 exchanges. That's the code section. Okay, guys? And this is rather than a taxpayer going out and buying a new asset or simply selling an asset, okay? He's going to swap assets with some other taxpayer out there somewhere. But the idea here is that, you know, we're going to swap assets, and because this taxpayer's economic position really hasn't changed at all, we're not going to tax them at this time. It just isn't the appropriate time for taxing. Simply, you know, I have a machine that taxpayer over there wants, he has a machine I want, and we're going to swap, okay? I'm not in any better position than I was before. I don't have cash in hand, I didn't just sell this, okay? So it doesn't make sense to tax right now. I have a continued investment in a business asset. So Congress is going to grant us a deferral. Now, in order to get this deferral, okay, there's 3 requirements for these like-kind exchanges. The first one says that property must be exchanged solely for like-kind property, okay? You have to exchange property for like-kind property. Now, in the case of real property, it's a pretty loosey-goosey definition, okay? You can more or less exchange any type of real property for any other type of real property. You can exchange commercial for residential. You can exchange, you know, farmland for an apartment building. You can exchange a bowling alley for a restaurant. When it comes to like-kind exchanges and the exchange of real property, they're pretty open, okay? As long as it's real property for real property, you're pretty good. Not the case when it comes to tangible personal property, okay? The rules say that it has to be of the same asset class and of the same general use within the business, okay? It has to be the same asset class and has to be the same general use. So I could exchange, you know, my car for a truck through the same asset class or the same general use. I could swap a computer for a computer, that'll work, okay? But I can't change a car for a computer, okay? They're not the same general use. We're using those for different purposes, okay? So real property is pretty open definition, but tangible personal property, same asset class, same general use. Guys, there are several types of properties that cannot be put into like-kind exchanges. Beware of them, okay? Inventory. You cannot swap inventory in a like-kind exchange and get deferral, okay? Financial instruments. And the book mentions also partnership interests, okay? You cannot put these things into like-kind exchanges and get deferral. They would be treated as sales. Okay? Our second rule, guys, says that both the property I'm giving up in the exchange and the property I'm taking in the exchange must be used on both ends of the exchange, either as investments or in the trade or business. And on the other side, the same thing. They have to be used as investments when I receive them, or they have to be used in my trade or business when I receive them. If use on either end is personal, you're gonna fail the test. You're not gonna qualify for a like-kind exchange. So if I have, my personal automobile that I swap for a computer that I'm gonna use, well, that wouldn't work anyway. If I have my personal automobile, let's say, that I'm gonna start this business and I'm gonna swap it for a truck, a delivery truck that I'm gonna use in my business, okay? Because the computer is personal, when I put it into the exchange, I'm gonna fail the exchange, okay? It has to start as an investment or trade or business property, and the property you take in has to be used as an investment or trade or business. Again, if there's personal use on either side, you're gonna fail the test. They go through a lot of this in the book, guys, so you can read on this. Just also, what I'm gonna point out, guys, keep in mind, there's two parties to this transaction, okay? There's yourself who's giving up property and receiving property, and then there's the person you're trading with, okay? You could pass while the other person fails. Everyone has to pass or fail on their own merits, okay? Just because one party fails doesn't automatically disqualify the second party, okay? They have to look at these rules from their own standpoint. Okay. The third rule for the like-kind exchange, guys, deals with timing, okay? Ideally, your exchange will be a simultaneous exchange. You'll swap the assets at the same exact time. You'll deliver your car, they'll deliver the truck, on the spot, and everyone goes home. But more often than not, guys, that's not going to be the case. In business, a lot of times the parties use what are called intermediaries. So they may give up their asset to this intermediary who goes and sells it. The intermediary takes the cash from the sale, and then they track down a new asset. Now the rules here say that if this is the case, new property, replacement property has to be identified, okay? You have to locate this property and identify it within 45 days if you're giving up the old asset. And you have to receive the new property within 180 days or by the date by which you file the tax return, whichever comes first, okay? So you have to first make sure you identify the specific property within 45 days if you're giving up the old asset. And then you have to receive it within 180 days or by the time you file your tax return, whichever comes first. Okay. Now, assuming you meet all three rules of the requirement, okay, you're going to qualify as a like-kind exchange. And again, the idea here is that you don't have to pay taxes on this realization event, okay? You gave up an asset, you would have calculated a realized gain or maybe a loss, okay? But you don't have to recognize it. You don't have to record it. That's the benefit of this provision, right? We like to defer our gains. That's our goal as a taxpayer. And then additionally, okay, so we defer our gain, and then the mechanism we use to defer the gain, guys, is the basis of the asset. We take what's called an exchange basis, okay? So when we take in this new asset, we look to the basis of the asset we just gave up. We adopt the basis from the old asset and exchange it into our new asset, okay? It's called an exchange basis. We look to the value of the old asset we gave up, and we make that be equal to the basis of the asset that we're taking on, okay? So think about it this way. We have company A, okay, they have this asset, fair market value 50, adjusted basis of 30. They want to swap it with company B for their asset. It's got the same fair market value, right? The trade has to make sense, guys. The fair market values at the end of the day should line up. And they have an adjusted basis in that asset of 40, okay? If the exchange qualifies, the idea is that, look, I'm getting this new asset worth 50. This is the new asset. I'm giving up this asset worth 30, okay? So I have a realized 1231 gain, right? Because this is a depreciable personal property used in my trade or business, so it would be a 1231 gain, okay? But if I meet all three of the rules we just talked about, then 1031 comes in and says you don't have to recognize any of that gain. Okay, you're not going to report any of it today. But this is a deferral, okay? It's not a permanent exclusion. They're not saying you don't ever have to report this 20. They're just saying you don't have to report it right now. But if and when you go to sell this asset, the new asset you just received at some later date, well then you're gonna have to report that gain then, okay? And how they do this is by saying that you're gonna take an exchange basis in the new asset. So I'm getting this new asset, which had a $40,000 adjusted basis to its old owner, okay? But under these rules, we say no, this is gonna become my basis in the new asset. So yes, I'm taking this new asset, and it's gonna get an exchange basis of 30. So I'm looking to my old asset, and I'm taking on this basis. And think about it, guys. So now, if I, 2 weeks, 2 months from now, whatever, turn around and say, you know what, I didn't need this asset after all, and I sell it, well, it should still be worth 50, right? Minus my new exchange basis in that 30 means I'm going to recognize eventually that $20,000 if and when I dispose of this asset. Of course, guys, if it's years before I sell it, there may be appreciation, depreciation, but the point is they're trapping this gain in the basis, the exchange basis, for later recognition, okay? So the basis has a purpose. Good? Okay, now I just said, in doing these exchanges, guys, we need, right, to make the deal equitable, you're really gonna want a deal where the fair market value is gonna more or less equal the fair market value of the other asset. Now, when you're trying to exchange machinery and trucks and things of this nature, guys, a lot of times the values aren't gonna exactly align. So chances are one of the parties, or maybe both of the parties, are gonna have to kick in cash, or they're gonna pay off your debt, or maybe they're gonna throw in another smaller asset to kind of equal out the trade, okay? Any other assets, cash, debt relief, kicked into the deal to even it out are referred to in tax as boot, okay? These are referred to as boot. Now, if you think back to the first rule, we just said that the first rule to qualify for like-kind exchanges say you have to exchange property solely for like-kind property, solely for like-kind property. So you're saying, okay, boot is going to violate Code Section 1031. It doesn't, okay? The rules say that to the extent you receive boot, okay, you have to recognize the fair market value of the boot as gain or the amount of the gain itself. So you're still going to go in, you're going to calculate your gain, but if you receive boot as part of this transaction, the rule says you'll recognize some portion or all of this gain depending on the amount of boot you receive. We'll go through a bunch of examples, okay? I'm going to point out here, guys, with like-kind exchanges, the rules say if you put a depreciated, lost piece of property into a like-kind exchange, okay, you're going to defer your loss. We, as taxpayers, we don't typically want to defer our losses. We want to pull them forward, guys. So I'm going to point out that it's usually going to be smarter, if you can, to just sell the lost property. Sell it to a third party. Don't exchange it. Don't put it into a like-kind exchange. Okay? If you put it into the like-kind exchange, you're going to defer it till if and when you eventually, 2 months, 2 years, 5 years from now, go ahead and sell that piece of property. We don't want to do that usually, okay? So sell it, recognize the loss immediately, because the like-kind exchange provisions will defer your loss. Let's look at problem 56. We'll look at a few problems here, actually. Okay, we have case. An individual purchased some property in Potomac, Maryland for $150,000 10 years ago. Case is approached by a real estate agent representing a client who would like to exchange a parcel of land in North Carolina for Case's Maryland property. Case agrees to the exchange. What is his realized gain or loss, his recognized gain or loss, and basis in the North Carolina property in each of the following alternatives? So, this is number 56. We have a taxpayer who has real property in Maryland. This is for Maryland. And he originally paid $150,000 for it. And he is going to exchange it with another party for property in North Carolina. Okay, so he's swapping real property for real property. Presumably he's using this in his business. Part A tells us that it's a, let me read it to make sure.
What's the NY?
Maryland. The transaction qualifies as a like-kind exchange, and the fair market value of each property is $675. So first they're telling us that this qualifies. He met all three of the rules. And the fair market values of both properties are $675,000. Okay? And they want to know who's realized, who's recognized, and his adjusted basis in the new property, which is the North Carolina property. Okay, guys? Realized gain, guys, is just code section 1001. What does he receive? What does he give up? Okay, just calculate the difference between the two. He's receiving a piece of property. They're both worth $675. So he's receiving this new North Carolina property, which is worth $675. He's giving up the old Maryland property, which has an adjusted basis to him of $150. So he's going to realize a gain of $525. Okay? It's a triggering event. He disposed of something. But code section 1031 steps in, okay? It's a qualifying like-kind exchange, so he does not have to recognize this gain at this time. So he's going to recognize and report. Recognize just simply means what's he going to put on his tax return. He's going to put none of that gain on his tax return, okay? And then the question becomes, well, what basis? Since now he's given up this Maryland piece of property and he has this North Carolina piece of property, what's his basis in this North Carolina piece of property? Okay? When there is no boot involved in the transaction, he takes an exchange basis. An exchange basis means he looks to the adjusted basis of the property he gave up. So he's going to take a $150,000 basis in this new North Carolina property. That's coming from his basis in the old Maryland property. Again, and that's because there's no boot involved anywhere here. Okay? All right, part 2 says the transaction qualifies and the fair market value of each property is 100. So it's the same problem. He still qualifies, fair market value drops to 100. Okay guys, we're going to go through the same thing. What's his realized gain? Again, it's the value of what he receives. He's receiving the North Carolina property at a fair market value of 100. He's giving up the Maryland property, the adjusted basis of 150. So he's calculating a loss of 50. He has a realized loss of 50. This is a qualifying transaction, they tell us, okay? So he's going to recognize 0. What should he have done? He should have sold it, guys, right? If he sold it to a third party instead of exchanging it, he could have taken advantage of this $50,000 loss this year. But now he put it into, and he can't use this loss now until he goes and sells this North Carolina property. And we want to know the adjusted basis of the North Carolina property, okay? Again, it's going to be 150 an exchange basis because there's no boot involved. So he's simply going to look to the value of the Maryland property he gave up. Okay.
Question.
Yes, sir.
So the adjusted basis, once the exchange is adjusted basis, it's just made. Is it the basis? The adjusted basis of the new property is it the basis of the old property?
When there's no boot involved. If there's no boot involved in the transaction, meaning there's no extra cash payments, no debt relief, no extra little assets tacked on to even out the trade, there's no boot involved, you look to the value of the old asset you gave up, the adjusted basis of the asset you gave up. We're going to change that rule in a little bit. Okay. Let's look at number 60. We have Metroport. They traded machine A for machine B. And then they give us some information which I will write out. So we have a corporation, and they have machine A, and they're swapping it for machine B. Okay, and they tell us that this machine originally cost them $50. It currently has an adjusted basis of $25, which means they took accumulated depreciation, guys, of $25. And part A, Tuesday tells us the fair market value of machine A and B are $40,000. The exchange does not qualify. Okay, guys, if it does not qualify, it's a sale and a purchase. Okay? So A says the fair market values of the machines are 40, and it does not qualify, therefore it's a sale and purchase. They're going to sell the machine A and they're going to buy machine B. Okay? So what is their amount realized? They're getting machine B at a $40,000 fair market value, it's machine B. They're giving up machine A, okay, I'm going to write this out the long way, had an original basis of 50. They took accumulated depreciation of 25. So they have a realized gain of 15. What's the character of this realized gain? Anyone care to comment? It's 1231, right guys? They're giving up, first of all, they're selling a 1231 asset. It's depreciable personal property used in trade or business for more than a year, okay? They took depreciation, so when we see depreciation, we're thinking about recapture. So initially to start as a 1231 gain, but then recapture 1245 would come in and say the lesser of the amount of the gain or the accumulated depreciation becomes ordinary income. So this would actually all be reported as ordinary income. Okay. How much of this are they going to recognize? They're going to recognize the whole thing. Okay, this is a sale. It's not qualifying for deferral, so they have to recognize all $15,000 today. This is a simple sale. They're going to report $15,000 of ordinary income. And what's their basis going to be in machine B? It's going to be 40. Yes. Okay, guys? Instead of taking the exchange basis and looking to say what's the basis of the old asset I gave up, because it's a sale, they take the fair market value of the new asset they're receiving. So they're going to take it at 40. Okay. I think B is the same, except for now it's a qualifying exchange. So the assets are still worth 40, but now it's qualifying. So now it is going to be a 1031 transaction. Same thing, guys. Okay, they're going to get machine B at 40. They're going to give up machine A. Maybe $15,000 realized gain, and yes, it's going to be an ordinary gain. Okay, how much are they going to recognize? Zero. It's 1031. It's qualifying. They're not going to recognize any of it. And what is their adjusted basis in machine B going to be? 25. Right, it was original basis 50, adjusted basis, so after they took depreciation. At the time they give it up, guys, their basis is only 25 in it. So it'll be 25. C, the fair market value of machine is now, machine A is 35, machine B is 40, okay? So that would be an uneven exchange, so someone's gonna have to pay boot. Metro exchanges machine A and $5,000 cash for machine B. Now we have a lopsided exchange. So here, A is at a fair market value of 35. So they're going to have to take in cash of 5 to equal out the trade. Okay? Same transactions, guys. What's the amount realized? What are they receiving? They're receiving $40,000 for machine B. What are they giving up? I can't remember. It's not the S, it's 35. But they're giving up the same things. Look, first they're giving up machine A, right? At an original basis, 50, minus accumulated depreciation of 25. What else are they giving up? Cash. They're giving up $5,000 cash. up to 10. And yes, you would go through your 1231 rules to figure out how much of that might be ordinary income. How much are they going to recognize?
How do you get 10?
40 minus 25 would be
Oh, wow,
15
you're right.
minus the $5,000 cash.
I'm living somewhere else.
But
You're
my
right.
math is bad in my head, so you never know.
You're right.
They recognize the 5,000, okay?
Okay, but what do the rules say about boot? You're not going to recognize anything here because, okay, they're paying the boot. It's when you receive boot that you recognize gain, okay? They are paying boot here, so they're not going to recognize anything. Okay? It's when you receive boot that you have to recognize, not when you pay it. Okay? And what is the adjusted basis of machine B? Okay, guys. Now there's boot involved, so we can't just take a straight up exchange basis and say 25 anymore. Because now there's boot involved, even though they're doing the paying. So the rule here says, or the easier one to remember anyway, the book gives you two different ones, is take the fair market value of the asset you're getting, okay, fair market value of B, let's say, minus your deferred gain. What is your deferred gain? 10, right? We realize a gain of 10, we're not recognizing any of it, so we're deferring 10 for some later date. So subtract off the deferred gain. So machine B, when we take machine B, we're going to put it on our books with a basis of 30, okay? Guys, conversely, if this was a loss, let's say, instead of subtracting it, you would add it to the fair market value, okay? So the rule says, when there's boot involved, you no longer take a straight exchange basis. Look to the fair market value of the asset you're receiving, subtract a deferred gain, or add a deferred loss, okay? If it was a loss, you would add it. And part D, the fair market value of machine A is 45, and Metro trades machine A for machine B of 40, and they're going to kick in cash, so it's working the other way this time. So now we have machine A, which has a fair market value of 45. We have machine B, which has a fair market value of only 40. So they're getting us cash of 5. Yeah. Okay. So again, same steps. Realize, what am I getting? How much am I getting? Way more than that.
Which is
Here, I'm getting an asset worth 40. I'm getting fair market value of machine B. Plus, I'm getting cash of $5,000 as well. So I'm getting $45,000 now. Okay? Minus, what am I giving up? I'm still giving up the same asset. Originally it cost me 50 minus my 25 of accumulated depreciation. 45 minus 25 means I have a realized gain of 20. Okay? What am I going to recognize? All of what?
Or is it just the $5,000?
Okay. The rule says when you receive boot, you recognize the lesser of the amount of boot you receive or the gain itself. So you can't, obviously guys, you can never recognize more than your calculated gain. Okay, so the rule says here we receive $5,000 of boot. So it's the lesser of the $5,000 or the $20,000 gain. So here I'm going to pick 5. Let's just say I received $25,000 of boot, but I calculated a gain of 20. Then I'd have to pick 20 to recognize. You can never be higher than this number. Okay? So here I'm going to recognize 5 because that's the amount of cash I received. Okay? And then the last part is what's the adjusted basis of machine B? And Okay, again, there's boot involved, so again, I'm looking to the basis of machine B. $40,000 is its fair market value. That's your starting point. Minus 15 for the deferred gain. I have a realized gain of 20. I'm only recognizing 5 of it this year. The other 15 is deferred. Okay? So minus 15. So my basis is going to be 25. Sorry. Yes. Plus, I've also got $5,000 of cash in my pocket. Okay? We good, guys?
So for like this, probably would realize a 25,000 or just 20? They've recognized 20, right?
The last one we just did?
I mean, no, they realized 20, but only recognized 5.
They realized 20. Again, it's just your very straightforward, what's the value of everything I'm receiving, whether cash, property, debt relief, okay? That's what I'm receiving, minus the adjusted basis of what I'm giving up. So that may be an asset and maybe cash, food I paid.
Yeah.
Okay, that's my realized gain, but I don't necessarily report that, okay? If there's boot involved, I'm receiving boot. Okay, the rule says you recognize the lesser of the amount of boot you receive or the amount of the overall realized gain.
All right.
Okay, and then when it comes to the basis, if there's boot involved, you take the fair market value of whatever new asset you're receiving minus the deferred gain or plus the deferred loss. Okay? Let's do problem number 61. This one's a little bit longer. It's the same steps though, guys, over and over and over. Start with realize, then calculate, recognize, is it qualified, is it not qualified, is there boot involved, who's paying the boot, and then you go to your basis. So in this problem, this is number 61. I'll read it. You have Trader Inc. They enter into an exchange in which it gives up its warehouse and 10 acres of land and receives in exchange a tract of land. And then they have a summary underneath. So this is company A, and they have a warehouse. These are all thousands, guys. I'm adding this column. This is not in the book, but I'm calculating this. They're also giving up land. And attached to the land is a mortgage, okay, liability. It's a $30,000 liability. And they're also paying cash of 20. On the other side, they're getting from B land, and the only thing we know about this land is that it has a fair market value of 340. Okay? And we have to go through the same steps. Now I'm going to tell you right now, liabilities, guys, when you're giving them up, the other party is assuming this liability, it's boot to you. It's as if they're giving you cash, and then you're turning around and paying off that mortgage or that liability. Okay, so if you're giving up a mortgage or a liability in the process, it's treated as boot. Again, think of it as simply they're handing you a bunch of cash and you're paying off that debt so that you're done with it. Okay? So, what's realized? What am I getting with that being said?
Land worth $340,000.
I'm definitely getting a land worth 340. Am I getting anything else? I'm getting the $30,000 in debt relief. Okay, they're paying off my mortgage. That's boot. That's something I'm receiving. So my amount realized is 370. What am I giving up? Okay, I'm giving up, guys. First, I'm giving up the warehouse. I'm going to write this out as an original basis of accumulated depreciation. I am giving up the land, which has an adjusted basis of 50, and I'm giving up cash of 20. So my realized gain or loss is 120. I'm I'm not gonna mix the problems on these down, guys, but I could say to you how much of this is ordinary, okay? And you should be able to work through that. I'm not gonna do that, but just keep in mind, what are we selling here? We're selling 1231 assets. Recap is gonna apply to some of this, okay, so we would have to go through that. We're not gonna focus on it here. How much am I going to recognize? Okay. Neither. Okay. There's a rule. Okay, guys, typically I just told you it's only when you receive boot that you report it, okay? And we are receiving $30,000 of boot, okay? But if you work through some of the problems in the book, what they don't print in the text, but what you find out in the solutions to some of the problems, is that typically you're not allowed to offset boot paid with boot received. So you might want to say, well, you're receiving $30,000, that's your recognized amount, okay? But when you are receiving and paying boot, so like here, I'm receiving $30,000 of liability and I'm paying $20,000 of cash. In this particular instance, it's okay to offset the two forms of boot, okay? So I'm gonna recognize 10. I'm gonna take the $30,000 I'm receiving, but I'm paying out 20. This is one of the few instances where it's okay to offset the boot received with the boot paid. Typically, you can't do that. So let's just say, instead of paying off my mortgage, they were giving me a truck to equal out the sale, so it was a truck worth $30,000. In that case, I would have to recognize the $30,000 value of the truck received, because that would be a case where I can't offset boot received with boot paid. But when it's two liabilities or it's liability and cash, you can offset, okay? It's in the fine print somewhere. So it's 10. And what is the adjusted basis of the land that I'm going to be receiving? What's my starting point? 340, which is the fair market value of the asset I'm receiving, minus 110, my deferred gain. I realized 120, okay, but they're only making me recognize 10 today. The other 110 is deferred for recognition at some point down the road when I go to sell this land. So minus 110. So I will have a basis of 230 in the land. And guys, again, think about it, because if I go and turn around and say, you know what, I don't need the land, and 2 weeks from now I sell it, well, fair market value is 340. The adjusted basis on my books is 230, so I'll receive $340,000 in cash minus my $230,000 basis under 1001. I will now recognize the $110,000 of gain that I didn't recognize originally upon the exchange. Okay, so that's the whole point of the basis rules. Okay, they're trapping that deferred gain or that deferred loss for later recognition when you sell the new asset. Okay, good, good, good. Okay, guys, so that's one type of deferred gain where we're not reporting today. Okay, it's a disposition of an asset, but here we don't have to recognize unless there's boot being received, okay? Another type are what called involuntary conversions. And this is code section 1033. Guys, and these are really events where taxpayers are being forced to dispose of property because of events, guys, beyond their control. They didn't want to dispose of this property. They more or less had to, okay, for various reasons. And Congress, guys, is going to grant this deferral at this time because to tax them right now would be causing a hardship on them. It wouldn't be fair to tax them. They didn't want to give up this property. They didn't voluntarily enter into this transaction. It was forced upon them. So it would not be an appropriate time to tax them. The idea here again, guys, is okay, we're going to grant this deferral under code section 1033 unless the taxpayers receive some sort of settlement and they don't fully reinvest it. We'll work through a couple of problems, but the idea is as long as whatever settlement money and insurance money they receive, they fully reinvest, replacing the asset that was destroyed or taken away from them, then they're okay. They don't have to recognize anything today. But if they take in, $500,000 of insurance and only spend $200,000 replacing the asset, well, they cashed out to the tune of $300,000, and they're gonna have to pay taxes on that $300,000, and we'll go through that. Now, there's two types of conversions that the book mentions, okay? There's direct conversions, guys, and this is really gonna be like maybe an eminent domain sort of case where the government comes in and takes your property because they need to put a railroad track right through where your house exists, and they're gonna say, we're gonna give you a house over here instead. That doesn't happen too often because the fact is you're never gonna get the government and a taxpayer to agree on, the same exact piece of property that happens to be available with the same exact house. So more than likely, we're gonna have an indirect conversion, okay? And this is really where they're gonna settle with you, okay? They're gonna give you cash for what they took, or you're gonna receive insurance money for what you lost, okay? Now, in the case of the indirect conversion, guys, you have a choice, okay? This provision is an election provision. You could recognize the full amount of your gain immediately if you chose to. But again, that goes against our nature as taxpayers. Our goal typically is to push off gains until tomorrow, like Scarlett O'Hara, okay? So typically what we're gonna do is we're gonna make the election to defer our gains. Okay, and in order to defer, you have to replace the property with what's called qualifying replacement property. You have to do this typically within 2 years of the close of the taxable year in which you received the settlement. Okay, so you might receive the settlement this year, you have to the end of this year, and then 2 more years. If it's a condemnation, you have 3 years.
So qualified depreciable property?
Qualified replacement property. Qualified replacement property, Jared, is, look, for like-kind exchanges, I just don't want you to get confused. For like-kind exchanges, we said you had to exchange like property for like property, but we said in the case of real property, they were pretty darn open to whatever type of swapping of real property. In this provision, they are not open to that at all, okay? Real property and tangible personal property both have to be exchanged for similar use types of property. So they're not gonna let you exchange the bowling alley for the restaurant here, okay? You have to go out and basically find another bowling alley, or you have to find another, okay? It has to be related in service and use. And as I said earlier, if the taxpayer does not reinvest all of the proceeds, meaning the settlement money or any insurance funds, okay, then he has to recognize gain to the lesser of the amount of the calculated realized gain or the amount not reinvested. Okay, a benefit of this provision over the like-kind exchange provision, okay, and like-kind exchanges, guys, I said you don't want to put lost property into an exchange because your loss will be deferred. Here it will not, okay? You can take your loss here immediately, because again, this is a hardship provision, okay? So if you're suffering a loss, you're allowed to take that loss. Typically that's gonna happen in your casualty losses, which we already covered in Chapter 6. But here you can take your losses immediately. They're not deferred. Let's look at problem number 62, put this to work. Here, we have the Baker Corporation. They owned a building located in Kansas. Baker used the building for its business operations. Last year, a tornado hit the property and completely destroyed it. This year, Baker received an insurance settlement. They had originally purchased the building for $350,000 and claimed depreciation of $100,000. They want to know what's their realized, recognized gains or loss, and what is the basis of the new building. And then they give us a couple of different scenarios. So here we have a corporation who suffered, this is really a casualty loss, guys, right? Which we looked at in Chapter 6. They originally purchased this building with a $350,000 value. They took accumulated depreciation at 100. So you can calculate that the adjusted basis is now 250, okay? Part A says Baker received $450 in insurance proceeds and they spent all $450 rebuilding the new business. That's good. So they received $450 of insurance funds and they spent all $450. So, same sort of steps, guys, right? Realized. What are they getting? They're getting $450,000 in cash insurance money. And they are not so much giving up as it was taken away from them. They're building, okay? The building that had the original basis of $350 minus the 100 of accumulated depreciation. So they have a realized gain or loss of $200,000. 1231, 291, the recapture rule guide do apply here, okay? They do apply. Again, I'm not going to smash the problems, but just to point out, you should be thinking that way. Okay? What are they going to recognize? Zero. They reinvested the money, guys, within the 2-year time frame, and they're rebuilding the same building, so it's the same use. So they don't have to recognize anything. And then the adjusted basis of the new building, we're going to go about this a little bit differently than we did in the other problem, guys. Look, they built this new building for $450,000, okay? Cost of the new building. But, again, this is not permanently forgiven. We need to track this for later use, or later recognition, I should say. Okay, this is just a temporary forgiveness. This is not a permanent forgiveness. So we have to do the same thing. We have to subtract off the deferred gain. So their basis in the new building is going to be $250. It does work out to be the exchange basis here, but I don't want to confuse things because you'll see why. Good? That's a yes. B, Baker received $450,000 in insurance proceeds and spent $500,000 rebuilding in the current year. So they kicked in some of their own funds. So they received $450 and they spent $500. Okay? Realize. What's my realized? It's the same thing, right, guys? It's don't be confused by the 500. Okay? When you are disposing of an asset by whatever means, you go back to code section 1001. The amount realized. What did I receive? Well, what did he receive here? They received $450,000 in insurance proceeds, okay? So $450 minus the same thing. They gave up the old building, value $350 minus the 100 depreciation. We've got the same 200. Okay? What am I going to recognize? Zero. Okay? He rebuilt it within 2 years. He met the requirements of the rule, right? He took all of the money he received and he spent it within the appropriate time frame on a building that has the same use. Zero. And what's his adjusted basis in the new building going to be? I hear a lot. Wait. All right, here, guys. Look, it cost him $500,000 to build this building, okay? So $500,000 is what it cost him to make this building. But again, this isn't permanent forgiveness, so we need to adjust for this, okay? So we're gonna subtract it off. And we're gonna make the basis of the new building only $300,000, even though he spent $500,000. Because again, if he goes to sell this building, this new building, in a month, a week, a year, 5 years, he's gonna recognize that $200,000 then, because it's not permanent forgiveness, it's just a deferral for now, okay? C, Baker received $450 in insurance proceeds and spent only $400,000, okay? That's gonna be problematic, okay? That's gonna be problematic. You have to spend what you receive. So he's getting $450 of insurance, and he's spent $400. My handwriting gets worse as we go. Okay, his amount realized. Again, what is he getting? $450. He's getting $450 insurance money. And he's giving up the same building. $350 minus the $100 of accumulated depreciation. He realizes the $200,000 again. What does he recognize? It's loud. 50. 50, right guys, 50, okay? The rule says here is, look, he got insurance money of $450. He pocketed $50,000, guys. He walked away with $50,000. You can bet they're gonna tax him on that. Then he cashed out part of his investment. So he's gonna have to pay taxes on the lesser of what he didn't spend, what he didn't reinvest, or the amount of the calculated gain, the lesser of those two. He walked away with $50,000 here. He has to recognize it today. They're not gonna let him defer that portion, okay? And then his adjusted basis of the new building. What's our starting point? 400, because that's what it cost him. That's what he spent on the new building. We're starting with 400 minus 150, our deferred gain, what we need him to recognize down the road. We're tracking it. So the basis is 250 here. Let's continue the fun. Baker received $450 in insurance proceeds and spent $450 rebuilding the building during the next 3 years. So he's received $450 in insurance. He spent $450. It took him 3 years to rebuild. Realize. Okay, we'll do the same sentence, guys. He got $450 in insurance money. He retired the old building. He's going to recognize, or realize, sorry, his 200. What is he going to recognize? He's going to recognize $200,000 here. Look, he didn't meet the requirements. He built the same type of property over again. He met that leg of the requirement, but it took him too long. He only gets 2 years, right? He took 3. So he has to recognize all of it. He's not going to fall under the provisions of Code Section 1033. So he has to recognize what he realized in full. Okay? And what's going to be his basis in that case? It's going to be $450, what it cost him to build it. We're not deferring anything because he recognized it all. Okay? Okay, guys, I know you're sad, but we're the last one. Okay. Are we good with this? Does anyone have any questions before now? Guys, it's the same pattern. You're seeing the same pattern. If you can work through these problems at the end of the book without looking at the book and do this and understand what you're doing, you'll be fine for the test, okay? It's as hard as it gets. Okay, last one, installment sales, okay? So we might sell a business asset, but rather than taking our payment all in lump sum right now, okay, I may agree to take payment over the next 2 years, 5 years, 10 years, however long, okay? This is called an installment sales, code section 453. Whenever you receive payment beyond the end of the taxable year, you have an installment sale, okay? And in this particular place, Congress is allowing us to defer our gain because we don't have the cash in hand to pay the tax bill, okay? So they are gonna allow us to defer the gain until the time we receive the payments. And there's a formula that we use to do this, which is called the gross profit percentage. Okay, and the rule just says take your total gross profit on the entire transaction over the contract sales, the amount you will receive in full. And you're going to take that percentage and you're going to apply it to each payment as you receive the payment, and that's what you will recognize in each year. Okay, there's sometimes where you can't use the installment sale method. Okay, you can't use it if you calculate a loss. So if you sell a loss asset, you cannot use the gross profit percentage. You can't defer it. If it's a loss, you can't use this method. You have to recognize it all immediately. Okay, you cannot use this method for the sales of inventory. Okay, so businesses can't defer the gains on their inventory. They have to recognize them all up front. They can sell to another party and take their cash over 5 years if they want, but they're still going to have to recognize the gain all in year one, despite what's happening with the cash. Okay, and you can't use it for marketable securities. Additionally, okay, we talked about code section 1245, code section 291, the recap rules, okay? Any portion of the calculated gain, so if you calculate your gain, with some portion of the gain relates to recap, okay? Any of the recap cannot be deferred. Only the 1231 balance portion of the gain can be deferred. Any recap has to be recognized in the first year. We'll do a problem. Okay, so you can't defer a recap. That all has to be recognized up front in year one. You can only defer the 1231 portions of the gain. Okay, let's look at 63. We have Russell Corporation. They sold a parcel of land valued at $400,000. Its basis in the land was $275,000. For the land, Russell received $50,000 in year one, and a note providing that they would receive $175,000 in each of years 1 or 2. And they want to know what their realized gain is, and then their recognized gain for the next several years. So here we have a corporation. They sell land, and the fair market value is $400,000, and their adjusted basis was $275,000. Okay, and they're going to take the payments, $50,000 in year one, $50 in year 0 this year, $175 next year, and $175 in the third year. Okay, so again, if you receive any payment beyond the end of the current taxable year, you have to go to this installment sale method. So you can start by saying, okay, well, what's their realized gain? What are they receiving? The whole thing, ultimately. All of it. Give me all of it. What are they eventually going to recognize as a gain? Or realize, I should say. Look, they're going to get $400,000 worth of payments, right? 50, 175, 175. They're going to get the fair market values. They're going to get their amount realized will be 400 minus their adjusted basis is 275. Okay, so their realized gain is $125,000. And if they received all of the cash in the first year, this would be what they would recognize. But they're not. They're receiving it over the course of 3 years. So you take this, okay, that's your profit. you take that 125 that they will ultimately recognize over the $400,000 of payments that they'll get, and you come up with a percentage, which is 31.25%. Okay? And then you apply this percentage to each payment as you receive it, and that's what you recognize. Okay? So in year 0, they're getting $50,000 times the 31.25%, and that is $15,625. And that's what they'll report on their tax return in year 0. Yes? Okay. Okay? In year 1, when they receive the next $175,000, they're going to multiply it by the same percentage again. And now they're going to get $54,687.50. So they're going to get $175,000 cash next year, but they're going to report on their tax return $54,687.50. Okay? Again, they're just simply allowing you to defer the recognition until the time you receive the payment, because you don't have the cash in hand. Typically, installment sale methods, guys, are used to sell big assets. Okay, we're talking about a lot of money. You don't have the cash to pay the tax bill. They're allowing you to defer the reporting of the taxes until you get the cash. Okay, that's what they're trying to achieve here. The same thing would happen in, do I have the years? Must be on year 2. But year 2 would ultimately be the same number as year 1. And if you add these up, guys, it's going to come out to the $125,000 that we started with, okay? It's just you're slowly recognizing it over the course of 3 years, rather than being forced to recognize it and pay the taxes on it all in the first year. I know you just want to go home and write the paper. Okay, one more. Problem number 64. In year 0, Javins Inc. sold machinery with a fair market value of $400 to Chris. The machinery's original basis was $317, and Javins took accumulated depreciation of $50. So its adjusted basis to Javins was $267. Chris paid Javins $40 immediately and provided a note saying he would get $60,000 a year for the next 6 years. Okay, so we're answering the same sort of questions. Okay, we have a corporation, they're selling machinery. Okay, guys, you're thinking of corporation selling machinery, it's a 1231 asset, they took some depreciation on it, you're thinking about 1245. Recapture, okay, has a fair market value of $400, and he agreed to take payments on that $400, $40,000 in the first year, and then in years 1 through 6, he's going to take $60,000 each year. Okay, it originally cost them $317. They took accumulated depreciation of $50, which means they have an adjusted basis of $267. Okay, first step is to figure out what is the amount realized. Okay, they're getting $400,000. They will ultimately receive $400,000 in cash payments. It's going to take them 7 years, but they're going to get it. Okay, minus the asset that they're disposing of. Okay, started out with a basis of $317 minus $50,000 of accumulated depreciation, $267. That leads to $133. Okay. I would tell you initially this starts as a 1231 gain, right? They're selling depreciable personal property used in their trade or business. Initially, this is 1231 gain. But, anyone?
So it becomes 291, or is that for individuals?
That's for real property. We're selling machine. So what applies when it's a machine? Sorry? 45, okay? Tangible personal property sold by any form of business, not just corporations, right? 1245, if you're selling tangible personal property on which the business took accumulated depreciation, is gonna apply. 291, guys, applies if it's a corporation selling real property, corporation only. 1245 applies to any form of business, partnership, sole proprietor, LLC, corporation, selling tangible personal property. So 1245 is going to apply. And 1245 is going to say the lesser of the amount of the gain calculated or the accumulated depreciation is ordinary income, right? So really, $50,000 becomes ordinary income. This is recap under 1245. And then the other $83,000 is still 1231 gain, which we would have to figure out what to do with after we put it into our netting process, okay? Now, I told you that when you have recap, okay, that recap income cannot go into our formula. We have to recognize that recap income instantly in year one. So here, rather than taking 133 over 400, we're going to take 83 over 400. You with me? Okay. Don't take the entire gain. We can't put that in. We're only going to take that 1231 balance. That's the only piece that's allowed to be deferred. So the 1231 balance over the amount that will ultimately be received, the contract sales price, okay, and come up with the percentage then, which is 20.75. Okay, we're going to apply this as we receive our payments. So in year 0, before you do anything else, take the $50,000 of recap. It has to be recognized in the year of sale. So first thing we're going to do is we're going to recognize that $50,000 of ordinary income. Plus, we're receiving a $40,000 payment. Take that $40,000 payment times your percentage. That works out to $8,300. Okay? So we've got $50,000 of ordinary income we report, and we have $8,300 of 1231 gain, which we would throw into our netting. Okay? Next year, well actually years 1 through year 6 will be the same for all years. Our $60,000 payment times our percentage means in each of those years we have 12,450 of 1231 gain, which would get thrown into our netting process in each of those years. Good? Questions about anything we covered today? Okay, again, if you can work through these problems and you understand what we're doing, then you're good, okay? The chapter ends with related party sales and losses between related parties, guys. Look, I'm not going to test it. We covered it already in chapter 7. It was the last page of that document I gave you guys with the capital gains. Don't worry about it, okay? Because we've tested it already. I'm not going to do it again. It's the last page, or hang on. 1135. It's on page 1135, like halfway through. It says related person lost disallowance. Don't worry about it. We tested this already when we did chapter 7.